So the first one is what we are now, this chart is comparing the equity return, starting from 2021 to right now, comparing MSCI China, Hang Seng Index, CSI 300, MSCI EM, and MSCI All Country World and S&P 500. And one interesting point, right? The top, the left-hand side, the three charts, it also represent the sentiment. Because when you talk about China market, you can talk about MSCI China, you can talk about, Hong Kong market, you can talk about the domestic China Asia market. They are all China and they are all investable. So MSCI China basically is an indicator or represent the offshore market, in the China space, is including Hong Kong market and other so-called Chinese equity listed globally. So it's relatively more sensitive and driven by the global sentiments, towards the China market. And then the second one, Hang Seng Index, is the Hong Kong market. Relatively is dominant by the, I would so-called domestic consumption, because Tencent and Ali, right now they are the big kind of like company, or component in the indices. And
Hello.
also you can hear me?
Yes, Jyoti.
Yes.
Okay. And then the banking sector as well. The banking is a big component, of the Hong Kong or the Hang Seng Index. But the real indicator or the real performance, I would say, is the CSI 300. This is the true, A-shares, 3,500 listed company in the domestic market. And is less driven by the so-called global risk on, risk off, on the China market. Historically, over the last year, people are talking about ABC. So this is a joke, right? ABC is anything but China. So as you can see, the MSCI China and Hang Seng actually, historically in 2021 dropped a lot, more than Hang Seng and CSI 300. Year 2022, when everyone is going down, I think the Hang Seng Index is doing a little bit better, but everyone is down. 2003, is recovering, but still is not an easy market, down 11, 10, and 9%. The interesting part happening, I think year to date, because if you look at the sentiment change, I think the first big rebound, if you like, happened in the Hang Seng Index in April this year. That's why, a lot of attention is coming in, etc. So as you can see, MSCI China actually and Hang Seng did a lot of better than the CSI 300. But if I have to come to a conclusion or action point from my perspective, I think the CSI 300 is more attractive and interesting. Oh, sorry about the jumping. It's more attractive and interesting than the company listed in the Hong Kong Stock Exchange or the MSCI China, because that represents the true future and is more investable in terms of selection than the offshore market. And one example is, for example, EV chain, right? Electric vehicle. A lot of people are investing in China. Part of it are investing in the electric vehicle supply chain as well as the high-end manufacturing. Only the big car manufacturer like New Xpeng, those guys are either listed in Nasdaq or in Hong Kong. But the real jewels, the component maker, they are listing in the China A-shares. So the domestic entity or the domestic company would be the future growth, and they are less driven by the so-called global risk on, risk on, off, on the China market. So this is the return, comparing to global and year to date, as you can see, we are seeing some capital rebalancing from Japan to some less extent from India back to the Hong Kong market. And that's why, MSCI China and Hang Seng Index actually outperform the MSCI World, and S&P 500, and people didn't notice.